So what's happening in the European debt market? I'll indulge 2 minutes in Jones Lang LaSalle. It's a global real estate advisory firm, roughly 44,000 people worldwide. In France, we're a lot smaller, only 400 people, but we cover all aspects of real estate services, whether it be tenant representation, project and development services. We also do a bit of space planning, capital markets, obviously, investment and disposal transactions, research with a group of roughly 200 professionals around the globe, providing such research pieces as IT and telecommunication workspace usage in France. You know, that very minute research, not only in quantitative terms, but also in qualitative terms, what kind of offices people are looking for and where they feel good. We also do a bit of investment management, and in that area, you'll be pleased to know that LaSalle Investment Management also runs a debt platform that put out 300 million euros last year in form of senior loan, preferred equity or mezzanine financing. So pretty much the whole spectrum of real estate services being covered. And as I said, you know, roughly, I haven't said it, but roughly 4 billion of sales last year. Done with Jones Lang LaSalle. On to the nitty-gritty of property debt, which is definitely a changing, very rapidly changing and extremely challenging market. First of all, where are property markets? Obviously, financing is only one part. What's interesting is the collateral. And obviously, in terms of investments, there's been a huge setback since 2007. At the peak, pan-European investment volumes were generously above 200 billion euros. And last year, there were only 123 billion euros. And even that was considered a good year relative to 2011. 2012 was 24% above 2011. So the market has really shrunk. And as many of you are aware, investors are really now very picky about their destinations. And an increasing polarization of the market with a number of cities coming up to the 12 o'clock, whereas some are staying at the 6 o'clock, where we're not too sure whether values are bottoming out or whether the capital value growth will accelerate. I'm pleased to report Frankfurt is in the right quartile, especially today. Obviously, three markets continue to dominate European investment volumes, and there are very valid reasons for that. The UK is the largest market. I'm afraid it has to do with the dominant language. We're here today in Frankfurt, we talk pan-European debt, and I'm expressing myself in English. So unfortunately, London remains a very core and attractive place for that reason as well. It has a legal regime that is creditor-friendly, so that also very much helps the debt component of capital markets financing to play a role in fueling investment volumes. Historically, also, London has evidenced very long lease terms, and that provides certainty of cash flows to foreign investors. And all that is maintaining London as an attractive place, in spite of a couple of drawbacks, of which, the pound sterling still being around. We're not too sure that it increases volatility, and the UK seems to be willing to stay outside the European Monetary Union. Also, another drawback for London is that it's heavily reliant on financial services and services surrounding the financial services industry for its take-up. So that makes it a heavily concentrated and relatively risky market for that reason. Germany is the second largest market. It's the largest and strongest Eurozone economy. So obviously it makes it a very safe and attractive place. There's a good functioning and an old-dated Pfandbrief market. And there again, the financing of real estate projects is facilitated by the background, by that legal background, just as much as the UK is favored by a relatively creditor-friendly legal regime. However, this is a market that evidences little volatility, so there's not much of a value-add play to be made so much in Germany as there is in the UK. Not that massive capital value swings as we've seen in the UK. And it's also a country where the investment market is a little more complex to understand, because there are, as you know, 7 regional hubs as opposed to just London or just Paris for the other 2 big markets in Europe. France remains an attractive place as well for foreign investors, not the least because it's the largest office stock in Europe. And it's the second largest in the world behind Tokyo. New York ranks behind Paris in office stock, would you know? And that's an interesting play as well for foreign investors who want to diversify their holdings geographically and have some exposure to real estate. In today's market as well, the Paris market is still perceived as quote-unquote safer as keeping your money in the bank if you're a foreign investor. The property capital values have held up quite well. The stock has been rejuvenated over the past few years without massive oversupply. Vacancy rate within Paris is still below 5% and has been for a number of years. So it's an interesting market for that, from that perspective. There's also a diversified tenant base, a good and skilled workforce, and excellent infrastructure to commute from home to work. So that's definitely an interesting area and location for foreign investors. And that in spite of subdued economic fundamentals, you know, near zero growth last year and forecast to be relatively the same this year. So not much glimmer of hope insofar as increasing take-up or capital value growth. There's also a number of uncertainties surrounding the tax regimes, and that is probably, unfortunately, going to last for a while. But in spite of these two drawbacks, France remains an attractive place as well for foreign investors. The Nordics and Sweden are coming strongly as well. Sweden has ranked 4th largest market in 2012 for property investments, and that's again demonstrates the ability of Europe to provide good diversity in terms of risk, in terms of currency exposure, in terms of tenant base, and infrastructure. The southern markets are extremely volatile, and that, you would believe, creates opportunities for players who are able to play the cycle. Unfortunately, it's still hampered by a legal regime that's more borrower-friendly, with court processes that are long and hard to completely forecast. And they obviously have even more limited growth prospects than the other markets we've quoted so far. In terms of lettings, there's definitely evidence of a subdued market. Gross take-up across Europe was down 9% in 2012. Obviously, you have the outliers. I think Düsseldorf performed quite well. But the outliers of Madrid, Milan, Barcelona all have had more than 20% drop in take-up last year, which explains why we're still 10% below peak, and why our rental index has dropped 1.5% year on year. So over there. Basically, the property cycle over the past few years has displayed the following set and sequence of events. You know, firstly, the debt financing dried up for development. And obviously, those who can keep funding development when the stock grows obsolete and you need refurbishment and tenants want new space, those who can fund those projects are essentially the listed REITs who have other banking facilities, who can tap the bond markets and don't really need structured finance to fund their projects through debt. So they have developed or renovated the stock. But now that they are listed property companies, they want to manage their vacancy rate, and they accept just as many tenant incentives and just as many rent reductions just to manage the vacancy ratios. And that puts pressure on rents in that newer stock that's been redeveloped by the REITs. So to the extent we don't find alternative sources of debt finance for new projects, it's likely that the REITs will continue to be the ones offering new stock or refurbished stock in our various markets. So we're still below peak, and unfortunately the largest demand driver for office space has always been employment growth, and that, as we've already said, is not to be expected in the near future. Another driver is the stock quality, and as there was polarization between location and investment market, there is polarization in take-up, with occupiers focusing on taking up new space or refurbished space rather than second-hand stock. There are a couple of swings that I'd like to mention to illustrate the volatility of the rental market. The West End peak rents were 100 to 110 pounds per square foot. It dropped like to something like 70, 75 pound per square foot in 2009, which is a 36% drop in the space of 2.5 years. And today it's in the 85, 95 range, which still is 20% or 18% below peak. In France, we've had a drop of 9% between 830 and 760. And to finish off with a nicer note, or not so nicer note, Q1 take-up in France was 40% down on 2011 and 20% down on 2012. So growth prospects in the lettings market are not that nice. Which explains why, or which is partly explained by the cycle of what happened between 2007 and today, and which our view is coming to some form of conclusion, whether it's a temporary or a lasting conclusion, not too sure. So the first step was obviously the unemployed people buying houses they couldn't afford on a 2+20 loan, 2 years interest only and then 20 years of amortization. They got caught by property prices not skyrocketing as expected. That created a loss of confidence in structured finance, and therefore the interbank market freezes over in the US because a lot of banks had inventory of mortgage loans that were not yet syndicated or securitized. It became contagious because other assets that banks wanted to liquidate to compensate for losses on the subprime market also have proven illiquid, and some securities had also been recycled through what were called SIVs, vehicles where banks provided liquidity facilities. So the whole system with accounting, mark-to-market accounting, exacerbated the issues, and then stocks and bonds also plunged. So all assets that banks considered to be liquid and immediately available for sale were no longer available. Step 3. Who is the lender of last resort? Governments bail out in the US and in Europe, whether Citi, RBS, Dexia, Helicopter then was at play, Super Mario 2, and the central bank intervention became critical to re-establish confidence, or if not confidence, at least short-term to then medium-term and then long-term funding from the central banks. The key question today is what will happen if that clutch of liquidity is removed. Nobody knows, and I'm not going to pretend I have a crystal ball. So unfortunately, you won't hear it from me this morning. But that remains a question mark for all involved in not only in the real estate industry, but more generally. The other question is how much political instability will that drive? Austerity measures throughout Europe are obviously unsettling and making people nervous. They don't really like the idea that the top of the peak is better off while they have to pay more taxes or see a reduction in their benefits. So austerity may result in political instability. And again, I have no crystal ball on that front. Some banks have been forced to restructure, forced to merge. JP Morgan, Wachovia, Bank of America, Merrill Lynch, Westimo, Commerz, Eurohypo. All of these have been driven by that initial loss of confidence in the structured finance market, and that also has created some lack of liquidity for all those. Are we now in the 5th phase of rebound? Obviously, in the debt market, new players have emerged, whether insurance companies, whether debt funds that have been raised either by former private equity houses or by insurance companies sponsoring them and providing seed capital. REITs have deleveraged and now are using the bond markets to a larger degree. France has seen 5.5 billion euros of real estate investment or SIIC, or listed property company bonds, issued last year, which is an increase from 2.5 billion the year before. So clearly there is momentum for property companies to move away from structured finance and mortgage financing to forms of corporate financing that rely on the entire balance sheet rather than a single project. And that is making room for all other borrowers who could use those 5.5 billion that are no longer needed from the banks in a mortgage format to fund their own projects. So we see a rebound in the market, in liquidity being made available not only by some people shifting from structured finance to corporate bonds, but also with the relaxation of the liquidity rule under Basel III, which was announced early January. So there is, we have seen an increase in banks' willingness to lend, aggressive origination volumes, and over the past 3-4 months, even increased competition in terms of spreads. So we'll comment to that. So today's property lending market is a diverse landscape of players who have very specific origination policies. Obviously, a few years ago, lenders were essentially banks in Europe, and they had an approach that was, we lent everything to everyone. You want to fund a logistics portfolio, you want to fund a development project, you will have financing from us. But since 2007, the banks had to think again and think hard of their origination strategies, of their sweet spots, of where the market was going and where demand would be present from borrowers. So each lender that has survived the crisis now has a very distinct investment and origination policy. Some are extremely focused on providing affordable, I'm not saying cheap, I'm saying affordable margins, but they will focus on core assets and core locations. Others will want to deploy larger amounts, but they want higher returns. So they will focus on providing higher loan-to-value loans and larger ticket size, because they think that's where they're going to make a difference. So each of the banks that are still active has been thinking of its strategy and defined the market segment that it wants to occupy. Obviously, the new players have had to raise capital from third parties and wanted to be able to deploy that on a discretionary basis. And therefore, they had to build a business plan that was convincing enough to those third-party investors, and to focus, without a track record, they had to have a very specific investment strategies. Some focus on the regional markets, some focus on development or value-add strategies, and they occupy an area that some of the bank lenders are now retrenching from. So definitely, there is enough liquidity at the moment in a number of segments. Some segments, such as development, are still lacking some debt financing liquidity, but others are extremely competitive. So we have reached a stage where the risk-return spectrum is now, fully covered. Maybe not adequately in some areas, supply and demand imbalances remain, but the whole, whatever property you want to fund, there will be one lender around, or a handful of lenders to compete for that financing. In France, we have now identified roughly 10 billion of property financing to be deployed for this year alone. Of the alternative lenders, there are roughly 3 billion, but to be deployed over 3 to 5 years. In comparison with 12 to 13 billion for refinancing and 3 to 4 billion for acquisition each year, over 2013 and 2016, there's roughly 2 to 6 billion gap to be funded. And we think that part of that will be funded by extensions, and part of that by mezzanine lenders in those situations where the extension is not possible due to a too high loan-to-value ratio, given the partial drop in valuation. And that is keeping us busy at the moment. Lenders who like their client, who like the collateral, but are faced with a 65, 70, 75% loan to value, where they would rather lend at 50, 55. So they are asking their borrowers to find a solution to bridge that gap, whether with fresh equity or with mezzanine financing. And within the mezzanine financing landscape, 3-4 years ago, the first movers in that category were really aggressive as far as their return expectations were concerned, 15, 18, 20% return expectations, with an aggressive, I would almost say predatory lending approach, where whatever the minute default you would have in your loan, they would want to seize the asset at a deep discount. And that has caused some borrower concern that having those lenders into a deal would have them lose control at some stage. But as there was not so much NPL transaction, not so many NPL transactions carried out in the past few years, there's a new population of mezzanine lender that has emerged over the past few quarters with a lender's approach. People who just want to deploy capital, earn a higher coupon than senior mortgage, and then be repaid on time at maturity. So people that behave more as medium-term partners rather than as people who want just to be aggressive and opportunistic in trying to grab properties in a distressed situation. And that will help the market deleverage to the point where senior lenders are comfortable, mezzanine lenders are happy, have deployed their equity, and property and landlords can now focus on managing the assets rather than trying to find alternative sources of financing. So the market is driven by, other than the property fundamentals, is driven by the banking regulatory framework. As we said, 2011 and 2012 were years where people were sitting and waiting, where would the ball fall as far as Basel III was concerned. And in 2013, we've had relatively good news with the liquidity ratio regime being softened to a large extent. The insurance industry needs to comply with Solvency II and to grapple with the implications of holding properties either as a direct investor or as a senior mortgage lender. And that has capital adequacy consequences. Basically, up to 60–65% loan to value as a senior mortgage lender, an insurance company doesn't have to hold equity against its assets. Whereas if it holds a property directly, it has to carry 25% of their value in equity. So that makes a big case for insurance companies who do know the property market and have known it for decades to move to a safer investment strategy through debt financing. So around the debt, there's a number of factors. Environmental concerns are extremely key and essentially driven by tenant demands. Whether they actually behave as green tenant is a matter for debate. But at least in their request for bids or request for proposal and looking for properties, they really now put the environmental rating as a top priority. The lenders, we've mentioned insurance and banks. I think the pension funds are an interesting party. You may have read that Norges Bank Investment Management has issued a request for proposal to be advised on a roughly €5 billion debt fund across Europe. So they're looking for advice as to where to deploy it, how to structure the funds, etc. So it's an interesting evolution in that market as well. Investment banks, they're back. They've reduced their sales force, so they probably, most of them do cover Europe through London, but they're happy to investigate again large tickets, relatively high LTVs, and less sought after properties such as logistics or hotel assets. Mezzanine lenders I've touched on. We now have really two populations: those that want high single-digit, low 10-digit returns, low double-digit returns, and clearly want to play as an active lender rather than someone who wants to take control of a property and commingle or mingle within the asset and property management. The important thing about banks that I would like to highlight is that oftentimes their strategy changes every 3–6 months, depending on their origination policy, depending on whether there's good news on Basel III or not, and a number of other factors. But clearly, they are still active. As we said, for France, they're the largest and still will, I think, remain the largest provider of debt financing. But they need to be followed and monitored carefully because they do change every now and then. The funds, the debt funds in that respect are a more stable breed because they've built their business plan and raised equity to deploy over 3 to 5 years, and they really have a strict set of investment guidelines. Insurance will not compete with banks as far as origination is concerned. More likely than not, they will co-underwrite with the bank lender, and then either do it as a club deal or acquire it on the secondary market, but the day after the loan was originated. So the bank continues to front, and then the insurance company, the relationship and the origination, and the provision of ancillary services such as hedging or accounts management, which the insurance company will not compete against with lenders. So insurance company will move in at closing or the day after closing. Now, this is an indication of where spreads are. I insist on the fact that it's an indication, because if it was advisory, it would give rise to a fee and VAT and so on and so forth. So we have seen, and that's an illustration of what I was alluding to as far as borrowers' behavior is concerned. Some borrowers don't even believe you can reach 80% LTV in today's market and self-constrain themselves in their bidding process for properties, and they underwrite 55 to 60% loan to value on acquisitions, but they can push the envelope. They can push the envelope. And it's still relatively accretive. If you buy a 6% yielding property and fund it at 70% loan to value rather than 55, your total cost of funding will probably be 380. The 5-year swap is at 80 basis points this morning. So it's still accretive to try and push the envelope as far as raising debt on acquisition is concerned. We've seen, funnily enough, the higher the yield, the higher the LTV. We've seen 14% yielding assets funded at 75% LTV, 300 basis point spread. Okay, you don't find 14% yielding properties every day. But if you lay your hands on these, you still have 3 or 4 years of cash flow, you can definitely amortize your 75% loan down pretty quickly and find a bank that's comfortable with that. You may not raise 2 billion, but you can raise debt. We've also seen some value-add properties with 2 years remaining under the lease and a heavy refurbishment program, 55% loan to cost, 5-year facility, 300 basis points. That's aggressive. And it's a 150 million lot size. So that's a big ticket, which you wouldn't have believed possible last year. It's a spread at 300, which you would have considered maybe was 450 last year. So definitely there is competitive pressure in market segments, in places where the borrowers don't even believe it's possible. We've also seen a couple of lenders who have, I would say, not necessarily counterintuitive, but contrarian view of life. If you've only got 2 years if you've only got 4 years of lease under your property, don't lend 3 years. Don't lend 4 years. Lend 5, 7, 10. Give the borrower time to relet the property and don't have them constrained both by the end of the lease and the end of the loan. You take less risk if you extend a longer loan, because you give them time to recover value. If you give a shorter lease, you may feel that you have cash flow to amortize your debt as long as you reach the maturity date. But if the lease breaks a year after your loan, how do they refinance? So as a lender, you're in fact better off extending longer loans on short-dated income. So there are definitely lots of thinking going on at lenders at the moment to find the right way to make reasonable business with borrowers. Thank you. If you do have questions now or while we do the roundtable, don't hesitate.
Great. Thanks very much, Christophe.